let's dive into the trading accounts and financial statements. What are trading accounts? Trading accounts are final reports, in other words, financial statements produced after the year end on the basis of your bookkeeping records. That's simplest definition. So what do they consist of, the financial statements? So the first and most important one would be your profit and loss account, also called an income statement. So this statement is showing your sales, revenues against expenses, and finally profits. The next important one is balance sheet. So these are the two most important financial statements. The balance sheet statement is showing your cash, assets, liabilities, capital, equity, so the things we talked about. Finally, there is an additional one not every business is obliged to do and not every business is doing, but it is very useful. It's a cash flow statement showing your cash going in and out and cash closing balance. We will talk a bit more about cash flow forecast later on. So just one more thing to clarify, that during this masterclass, we are not going to cover the preparation of trading accounts financial statements, because in order to do it, you will need at least a full bookkeeping course in order to understand how to do it. I will just show you the examples to make you more familiar with what it is, how it looks like, and what it tells us, okay? What is a profit and loss account? We already touched on that, and that is the easiest to understand, I would say. Balance sheet is more difficult. So the purpose of the profit and loss account, also called income statement, is to report on the profitability of the business. So you will have your revenues as opposed to your expenses, and finally the bottom line, you will arrive at a profit or a loss. And if your revenues are bigger than your expenses, that's great, you are making a profit. If this is the opposite, the revenues are smaller than your expenses, you are making a loss. That's obvious. One important thing to turn your attention to, that revenues and expenses are recorded when the business earns or incurs them, not when the money is received or spent. So this is the distinction I talked about, expenses and cash payments. This relates to similarly to the revenues. So, and this methodology is called the accrual basis. Maybe it will be easier for you to understand when we look at this example. You sold goods worth 1,000 euro, but the customer is due to pay for them in 30 days. So your revenues, your sales are recorded now when you sold them to the client, but the payment will be made in the future. And this is a separate transaction, the payment. So the accrual basis is the recognition of the revenues and expenses when they occur. That's an important thing to remember. What is a balance sheet statement? This is a bit more difficult to understand how it works. But for you to know, the most important thing to know is that it will report on company assets, liabilities, and shareholders or owners' equity at a specific point in time. That's a very important thing, because this is what makes it totally different from the profit and loss account. Profit and loss account is for a certain period on time. For instance, for a full year, financial year. This is all your revenues and expenses during the year. Whilst the balance sheet statement is at a point in time, so at the end of the year. For instance, 31st of December. It's always at one date. Because the balance sheet reflects a specific point in time rather than a period of time, the balance sheet is also called a snapshot of the company financial position, usually at the end of the year. Some businesses, larger businesses, more complex, will do their balance sheet on regular basis, on a monthly basis, to understand their financial position. But for smaller businesses, it is usually done at the end of the year, okay, 31st of December usually. Example, for a balance sheet dated 31st of December, the amounts shown on the balance sheet are the balances in the accounts after all transactions which took place before 31st of December have been recorded. Okay, so remember, balance sheet is at a one point in time, profit and loss is for a period of time. So just a couple of tips for you in relation to preparing trading accounts. This will relate to the ones who want to do them themselves. So proper bookkeeping, very important thing, to regularly keep record of your spending, expenses and earnings and register everything on regular basis. The best approach is to schedule sometime one day every week and do it as you go. Don't leave it after the year end. Trust me, this is only a trouble. Okay. Again, keeping a separate bank account for your business is very helpful because the transactions will not mix with your personal transactions. You can always export the information online banking from your online banking, and it's pretty easy to stay on top of that. Another very good tip, use cloud accounting. I'd strongly advise to consider subscribing to a cloud accounting package like Xero. We use Xero and I highly recommend it. It will really help you to stay on top of your bookkeeping, and it makes it easier to do bookkeeping for people who are not familiar with accounting. Trust me, it's not too difficult when you grasp the basics. And it will also allow you to have real-time access to your financial data. At any point in time when you do your bookkeeping regularly, you will know how much you earn, how much you owe, and so on. You will have control over your business. The third tip is engage an accountant. If you don't want to do it yourself, if you feel that's too much for you, you can always engage an accountant and they will support you and they will make sure your accounting and financial situation is up to date, always.